Hi, welcome back to the channel. Over the last few trading sessions, something very interesting is happening in the financial markets. SpaceX, who we've been talking about on the channel, is the biggest IPO in history and one of the hottest stocks on Wall Street. And it's seen around $1 trillion wiped from its market value. At the same time, the Nasdaq has fallen by more than 5% from its recent peak. Semiconductor stocks have suffered one of their biggest sell-offs in years. More than 1 trillion has been wiped off the value of technology valuations, and investors are suddenly asking a question that almost nobody wanted to ask just a few weeks ago. Has the artificial intelligence boom become an AI bubble? But before we get into the details on all of this, could I ask anybody that hasn't subscribed yet to please hit that subscribe button? It only takes you a second to subscribe and it really helps the channel. So let's start off talking about SpaceX, because I think this tells us a lot about what's happening right now. When SpaceX came to the market earlier this month, investor enthusiasm was extraordinary. The shares were priced at $135 each. Demand was enormous. Investors piled in. The stock immediately surged higher, and within days the shares had climbed to $225. At that level, investors were valuing the company at around $3 trillion. If you just think about that for a moment, $3 trillion, that would have placed SpaceX amongst the most valuable companies on the planet. The company became the poster child for the AI era. Investors weren't just buying a rocket company, they were buying the future. Satellites, Starlink, defense contracts, artificial intelligence infrastructure, floating data centers, and autonomous systems. Most importantly of all, they were buying growth, and they were prepared to pay almost any price to get exposure to it. But over the last few trading sessions, sentiment has changed dramatically. The shares have fallen back towards the mid $150 range, and depending on exactly where you measure, it's lost 3, 2, 1. And at that level, it's lost around $1 trillion of market value. It's gone in a matter of days. To put that into perspective, we're talking about a sum larger than the annual economic output of many developed countries. So that's not just a normal pullback, that's a serious repricing of expectations. And here's the really important point. This isn't just happening to SpaceX. If it was, we could dismiss it as investors taking profits after an overheated IPO. But when we look across the wider market, we can see exactly the same pattern emerging. The Nasdaq has fallen by more than 5% from its recent highs. The S&P 500 is also moving lower. Technology stocks are being sold aggressively. And nowhere is that more obvious than in the semiconductor sector. The Philadelphia Semiconductor Index recently suffered one of its worst trading sessions in years, falling around 8% in a single day. Micron was down 13%, Marvel more than 9%, Qualcomm lost around 8%, Nvidia has also come under severe pressure. And these aren't speculative startups operating out of garages. These are some of the largest and most important technology companies on the planet. Collectively, they've lost hundreds of billions of dollars in market value. In fact, it's around $1 trillion that's been wiped off of technology stocks over the past few days. So what's changed? Why are investors suddenly selling stocks that only a few weeks ago they couldn't buy fast enough? I think the answer is quite simple. For the last 2 years, investors have been focused on one question. How much money can AI make? Every earnings call, every investment 3, 2, 1. Yeah. Every earnings call, every investment presentation, every analyst report, every conference, the conversation has been about growth. How quickly can artificial intelligence expand? How much productivity can it generate? How many industries can it disrupt? How much revenue can companies earn from it? But suddenly investors are asking a different question. How much is AI actually going to cost? And that's a very different conversation, because building artificial intelligence isn't cheap. Building data centers is very expensive. Semiconductor fabrication plants are huge investments. Building power generation capacity to serve all of that market is also a huge lump of capex. And building the infrastructure needed to support the AI revolution is going to require an extraordinary amount of capital. We're talking about trillions of dollars. And that spending has to be financed somehow. For a long time, investors weren't particularly concerned about that because money was relatively cheap. Interest rates were expected to fall, borrowing costs were coming down, the future looked supportive of that investment. But that environment is starting to look less certain, and that's where the bond markets enter the story, because while most investors have been focused on AI, something has been happening quietly in the background. Bond yields have remained stubbornly high. The US 10-year Treasury yield is sitting at around 4.5%. Long-term government borrowing costs are around 5%. Now, that might not sound particularly dramatic, but it does matter enormously because bond yields effectively compete with technology stocks. If investors can earn close to 5% lending money to the US government, they become much more selective about paying huge valuations for companies promising profits many years into the future. The higher yields go, the lower those future profits are worth today. And that's exactly the sort of environment that puts pressure on growth stocks, particularly stocks that have benefited from huge amounts of optimism. But that's only part of the story because this sell-off is taking place against an increasingly uncertain global backdrop. We've been talking for the past few months about the risks associated with the war in Iran. We've discussed the impact on the energy markets, the implications for inflation, and the possibility that higher energy prices will eventually start feeding through into the wider economy. Oil prices are still significantly above the levels that they were at the start of this year. Energy markets continue to be nervous, and investors are becoming increasingly concerned that higher energy costs will make inflation much more difficult to control. So why does any of that matter? Because inflation determines interest rates, and interest rates determines valuations. And if inflation remains stubbornly high, central banks may have less room to cut rates. So if rates stay higher for longer, bond yields remain elevated. If bond yields remain elevated, technology valuations come under pressure. And if technology valuations come under pressure, investors start reassessing some of the assumptions that have driven this extraordinary rally. Suddenly, everything becomes connected. The conflict in the Middle East, energy prices, inflation, interest rates, bond yields, technology valuations, artificial intelligence. What initially appeared to be separate stories are actually part of the same story. And I think that's why this sell-off feels different, because this isn't simply investors taking profit. This isn't simply one bad trading session or one company disappointing the market. This is a genuine reassessment of risk. For the first time in a long time, investors appear to be questioning whether some of these valuations are actually realistic. They're questioning whether the expected returns justify the enormous amounts of capital being invested, and they're questioning whether AI trades have become a little too crowded. Now, does that mean we're about to see a repeat of the dot-com crash? Well, that remains to be seen. The reality is that nobody knows how this is going to play out. But what we do know is that some of the biggest winners from the AI boom are now experiencing significant sell-offs. We know that hundreds of billions of dollars have been wiped off technology stocks. We know that investors are becoming increasingly concerned about valuations, and we know that markets are starting to question whether some of the expectations around artificial intelligence have been far too optimistic. So does that mean we're about to see a collapse on the scale of the dot-com boom? Probably not, at least not at this stage. Many of today's companies are real businesses generating real revenues and real profits, which wasn't always the case during the late 1990s technology bubble. But that doesn't mean that there isn't a problem, because markets don't need to collapse completely for investors to lose a lot of money. Sometimes all that happens is that expectations become disconnected from reality and valuations gradually return to more reasonable levels. And when that process starts, it can be really painful. So are we saying that the wider stock market is now about to collapse? Well, these things have a tendency to snowball once confidence starts to weaken. But it's too early to say at the moment whether this is the beginning of a much larger correction or simply a sharp pullback after an extraordinary rally. What is becoming increasingly clear, however, is that concern is rising. Concern that the market has become overheated, concern that valuations have become far too stretched, concern that investors have become too dependent on a handful of AI-related stocks, continuing to rise indefinitely. And that's why I think we're witnessing the first serious challenge to the AI narrative. For the last 2 years, almost every conversation has been about the opportunities, the growth, the investment, the future. Now, for the first time, investors are starting to focus on the risks. And if the current sell-off continues, if bond yields remain elevated, if oil prices stay higher for longer, and if inflation concerns continue to build, then this may prove to be the moment when the market finally starts paying attention to the risks that have been building beneath the surface for months. The question isn't whether we are seeing a correction. We clearly are. The question is whether this correction becomes something much bigger. And that's what investors around the world are trying to work out today. So I'll keep you posted on any further news and developments, but hopefully you found today's video useful, informative, and most importantly, thought-provoking. If you've liked what I've said, then please give me a thumbs up. Please subscribe to the channel if you haven't done so already. I'd like to thank everybody that's supporting me. If you bought me a coffee, thank you for that. If you sent me a YouTube super thanks, really appreciate that. If you've signed up as a patron, I genuinely appreciate your long-term support. And if you signed up as a YouTube member, thank you for that. Really does help to keep me motivated and making as many videos as possible.